U.S. labor productivity fell again this quarter, following off the back of a decline last quarter too. So now we're running at 2 straight quarters of U.S. productivity decline. And when you pair that up with what's happening with the unit labor costs in the U.S. Labor force, where that's ticking up as well, quarter over quarter, you're starting to see the dynamics here of something that's happening in the labor force that is fighting against the work that the Fed is trying to do to lower inflation. And then over a long enough time scale, I think speaks to a pretty negative outlook for the U.S. economy and then the U.S. kind of way of living, if you were to extrapolate that too. So U.S. Non-farm labor productivity, it fell to 4.6%. And we pair that up with what happened with unit labor costs, which increased 10.8%. And you think about the number of open jobs that are available in the U.S. and you think about the unemployment rate and how a lot of the news, especially last week following the jobs number, was that, okay, recession signals are a bit messy because we've never had a recession or a pullback with such low unemployment before. Now, you can talk about the technical recession, which is back-to-back negative GDP growth quarters. You can talk about NBER's definition, which is just kind of a sustained period of negative growth. But the more important thing to think about is how productivity is really tied to inflation. And if the goal of the Fed and really us as an economy is to try and bring down inflation, as workers, we really have to do our part. When you have falling productivity, that means, in a world where kind of labor unit costs were steady, we're still paying kind of the same amount of money for less production. But we've got the other side of the coin here, which is labor costs are going up in the U.S. as productivity is falling. So we're paying more and more for less and less productivity. And companies, of course, are going to, they're going to do, I guess, one of two things. They're either going to absorb the cost of higher labor, which is pretty rare, or they're going to pass that cost down to the consumer. So yes, we can do all the stuff that we need to do with the Fed, which is, to raise the cost of capital and all that stuff. But if at the consumer level, we're paying more for less productivity or fewer goods, we're not doing our part to help solve the equation too. So, and then, on a long enough time horizon, something I touched on earlier, rising productivity is how you grow living standards. I mean, here in the U.S., I think if we're objective about it, we really have a great standard of living compared to many, many places across the world. But that's a function of a lot of the groundwork that's been done over the last many, many decades in terms of growing productivity. And so if this now is the start of this period where companies are having to pay more for less productivity, we're also shooting ourselves in the foot as a society with regard to our standard of living. So it's really messy, and I think the CPI print tomorrow is going to be very interesting to watch, because if we see the CPI print go up and inflation, the headline inflation and go up, despite all the stuff that the Fed is doing to raise interest rates, I think we can then point to what's happening in the labor force as probably a catalyst, or at least a proxy for what's happening in terms of inflation and why it seems impossible to pull down. So interesting numbers that came out today with regard to productivity, and just something to think about, from a management standpoint, from a worker standpoint, whether we can start to pull back or claw back levels of productivity so that we can do our part to help bring down inflation. Because if inflation stays up for a long time, then we're really going to see negative growth for a long time.